This is Matt Rastusha, and this is Argent Wealth Management's March and April Market View. At Argent, our differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof, helping to simplify your life. So what's the conclusion this month? The recession odds remain low. So recession odds remain low. And if that does remain the case, the bull market is likely to continue despite some of the volatility we've seen. The volatility we've seen has really been created by uncertainty about economic policy out of Washington, and we can see that weighing on consumer confidence. When consumer confidence is low, consumers invest and spend less, which affects aggregate demand and can lower GDP and economic growth. So despite that, the stock market so far has remained pretty resilient in the face of uncertainty, which is a good sign. There's been pockets that have corrected more than others, but in general, most sectors have been, flat to positive this year. Now, if that does change and we see a more broad-based sell-off, that would be a signal, the market's a forward indicator that investors believe that all this policy uncertainty, the tariffs, et cetera, we'll get into it, is really starting to affect investments and consumption habits, and therefore the economy in the future, really before the economic data tells us that. So I think we can expect some volatility to continue here until we get a little bit more clarity on, the tariff situation, how that's going to affect markets, consumer habits, and really until we see how the market reacts to all of that, because we'll get signals from that. But at least for now, the economy remains pretty strong. I mean, we've got the NDR recession probability model, and what I like about this is that it's looking at leading indicators. So indicators that talk about, that help predict historically the future of the economy, yield curves, how many building permits do we have, plans to build, share prices, the price of stocks, sentiment, and business surveys. So overall, recession odds around the world remain pretty low. And when that's the case, the market tends to advance over 11% a year on average. And credit conditions remain favorable and are on an upward trajectory. So if you want to expand your business or buy a home or get a home equity line, there's availability to do that. Historically, that measures on a downward trajectory before a recession, where we're just not seeing that. And unemployment, there's still 1 times the number of job openings per unemployed in the United States. So that's come down a lot, but that's still well above the average since 2000. So the job market's still pretty strong. And as long as the job market's pretty strong, unless that changes drastically very quickly, you're just not going to get a recession. Without a recession, you typically don't get corrections much greater than 10% in the stock market. The issue is that because the economy is strong or has been strong, aggregate demand remains elevated. Again, that may change depending on what happens with consumption habits in the future, depending on economic policy. But for now, we're seeing a lot of strength in aggregate demand, and inflation, therefore, is remaining sticky. And that's a problem, right? If inflation remains sticky, the Fed is not likely to lower rates. They have penciled in 1 rate cut at their last meeting for this year. We'll see if that changes. But as long as inflation pressures are kind of in that neutral zone where they are now, inflation is not likely to come down, towards the 2% target the Fed has. It's sitting right around 3% plus minus. And here's the consumer confidence chart that I talked about. And you can see this really big drop right here. So despite this strong economic backdrop, decent labor market, confidence has dropped, and that really caught investors by surprise. This was last week, but this just likely reflects consumers' angst about inflation, right, which we just saw, and uncertainty in Washington D.C. over the economic policy. What's going to happen, and how's that going to affect us? And we just don't know, right? So at the time of writing this, Trump has signed executive orders imposing 25% tariffs on all goods imported from Canada and Mexico, and a 10% tariff on Canadian energy exports. So these are going to take effect March 4th. And in addition to existing tariffs, Trump announced a 10% tariff on Chinese imports, and that was effective February 4th. So that's essentially doubled on March 4th. So Trump also announced on February 26th plans to impose a 25% tariff on goods imported from the European Union. So he is imposing tariffs across the board. The thing about tariffs is that it increases the cost of goods, right? And so it's supply push inflation, and inflation's already sticky. And when you get this kind of, you get when supply, when inputs increase in price, what you get is prices going up, but GDP going down. And so that's a real issue because the Fed doesn't really have control of the supply side inflation. They really only control the demand side, how much consumers are, what's aggregate demand. So it's no wonder the market's been volatile, wondering, okay, if we're going to get increased prices from supply and the Fed can't control that, and you're getting aggregate demand going down because consumer confidence is going down, could you get increased prices and lower GDP? That's worst case scenario. We'll have to see what happens. A lot of pundits believe that with Trump, if you look historically at what he's done, if his policies really start to impact markets in a negative way, he tends to figure out a way to pull back because it's important for him that the stock market does well. So, there's kind of three levels of uncertainty, right? There's what will policy be exactly, and that could change. And second, if it's implemented, what will the effect actually be? And we may not know that for months, but people are going to speculate. And then third, how much his proposals are those negotiating tactics, which we just talked about. And here's that economic policy uncertainty, data. You can see this huge spike very recently. And again, that can lead consumers and businesses to think about their purchases a little bit more before making them and slow the economy down. And so you can see because of this uncertainty and because, investors are a little bit worried, you saw a drop in yields. When investors are worried about potential effect of changes in economic policy, for instance, they're going to reach for the safety of bonds, and that drives yields down. So you can see this blue line here. Now, and 1 month ago was up here. So the 10-year yield was over 4.6%. Now the 10-year is around 4.25. So a nice little drop there reflecting concerns. And that drop in yields is essentially the the investors in the bond market pricing in 2 to 3 rate cuts this year. As you can see on this chart down here, the odds of what rates are going to be at future meetings based on the yield curve. And so investors are predicting 2 to 3 rate cuts, but the Fed at the last meeting said that they only expect 1. So we'll have to see if the Fed, conforms to the market, or if things improve and the market kind of comes back to where the Fed is. But again, this is way more uncertainty than we had, I think, at the beginning of the year, and lots more than we had last year, because last year investors knew there's no really expectation of any change in near-term policy. And so the market was able to thrive. And so you can see, despite the uncertainty, though, the S&P 500, most sectors, and you can see most sectors up here, besides technology, at least, as of 2/28, the end of the month, they were positive. Financials were very positive, over 6%. Real estate is coming back. Communication services, energy, staples, utilities, industrials, and overall the S&P was still positive. Technology was negative. It's a very large percentage of the S&P, and the MAGs, which is kind of this new term. It's at Microsoft, Apple, Nvidia, Tesla, Meta, Google, 7 MAG 7 stocks, and there's an ETF that owns them in equal weight, and you can see the return this year, is down significantly, more than other sectors. And that's a large part of the market. Those are 7 of the 10 largest stocks in the S&P 500. So despite, a pocket of the market already drastically coming down, and they were really overvalued and done so well, they're up over 35% in the last year. So not surprising to see a little pullback there. the market's been resilient, and that's a good sign. And that's basically investors saying, hey, we know there's uncertainty, we know there's issues, but economy is still strong, and without a recession, nothing majorly bad can happen. And we're seeing parts of the market correct that were overvalued. That's all healthy stuff. If that starts to change, though, and you see a lot of these sectors start to go negative and drop in unison, and there's no difference, and there's negative breadth, they call it, where everything's going down. That's a sign that stock investors are now pricing in that economic policy and what's going on is going to affect the economy in the future, and they're starting to price that in. That potential is greater than it was. And then we'll have to see what the economic data actually is, what the leading indicators tell us, but also if the market reacts in a very negative way. For example, the S&P crosses below its 200-day moving average. Other indices are doing the same thing. Many stocks are below key moving averages from the technical perspective. That's usually a negative sign about the future. So those are the types of things we're watching here at Argent. At the same time, how much bad news is already priced in? Right now we're seeing a lot of negative sentiment in the market. It's pretty negative, and when it's negative, you can see the stock market tends to go up about 26% on an annualized basis. So investors are already worried. How much more worried can they get before the market starts to balance out and catch itself? We will see. Sentiment's one thing, but fundamentals are another. And the fundamentals are starting to break down. It doesn't matter how negative sentiment is, it can stay negative. But typically, if you believe that things are going to stay stable and the economy is not going to go into recession, when this indicator is negative, it's a good buying opportunity. And here's just a valuation for the MAGs. I'm just showing you it's much more reasonable now. So, coming into the year, it was 35. Now it's at 28. And again, that's just where we're at with those stocks, and those are a pretty large percent of the S&P 500. So it's important to pay attention to. And you can see, despite the correction in the Mag 7 stocks, they still outperformed the S&P over the last year and are up 35%. So they've come down 20%, but they're still up 35% the last year, which is well above most sectors. And so now that you have valuations more reasonable, sentiment pretty pessimistic, and the economy still remains in good shape, and those are leading indicators, right? So those aren't coincident, those aren't lagging. If that does remain the case, I do believe a stock market correction in that 10 to 15% range would be more of a buying opportunity than a warning sign to sell because there's more damage to come. Again, that's if that data stays in good shape, the economy remains in good shape, and some of the technical indicators that we're not going to get into in detail here, it gets pretty complicated. If those remain resilient as well, then we're going to look to potentially take advantage of the volatility. If that's not the case, then we may look to get more defensive, and that's okay. Again, I think recession odds are still pretty low. So, but again, if that does changes, I don't think there's high odds of that, but if that does changes, we'll act accordingly. So thanks for listening. This is Matt Restuccia, the Chief Investment Officer and a principal at Argent Wealth Management, and I appreciate your time.